Hello from Berlin, Germany, everyone. Hope everyone is ready for our Shark Week presentation. For those who are not familiar with us, we've been part of the Shark community for many years now. That's me to the left, Chris Lassen, and Harry, also known as Fat Tails, our market lizard to the right. His indicators are some of the most downloaded for the NinjaTrader platform. You'll often see them discussed in the Shark Indicators weekly workshops, as well as over at the NinjaTrader Support Forum and Futures IO. These, of course, are the AMA open source indicators. And chances are that many of you already have a few of them downloaded to your PCs. As for myself, I previously ran a company that focused on sentiment analysis for financial news, looking at how emotions and psychology drive the markets. You'd think that that would be very much at the forefront of the markets again these days. Markets driven by greed and fear, and I will get back to that shortly as we look at defining market trends. I'll just do a quick intro on what we offer first. We have the Indicator Spotlight newsletter that you can subscribe to free of charge. On a regular basis, we feature one of these indicators with information on a trading setup or a general concept from technical analysis, how to apply it, along with a free download of the indicator itself. So really nothing to lose here. Great content and free downloads. So go ahead and subscribe to that if you haven't already. And all of the indicators featured here are based on our indicator library suite. If you're just starting out, that is a great place to find and explore various trading techniques. You'll find categories for support resistance, momentum, price action, volatility, volume, trailing stops, you name it. Close to 150 open source indicators available. And even if you're an experienced trader, chances are that you will find some pretty useful tools there. So that is our baseline offering, all available for a one-time flat fee of $150, no recurring payments. No recurring payments either for our premium indicators. The premium suite contain professional session tools, the multi-time frame opening range, the pivot and VWAP packages, as well as our flagship tools for entry timing, namely the auction bars, the zero lag oscillator. We also have a premium Ichimoku version in there, our own Renko bars, and the recently added swing trend analysis for detecting market structure. All right, let's go get down to business here. We'll start with the general information on how to determine trend bias. Generally a good idea to review trends from different perspectives. Just as with legal or medical advice, you'll probably want to get a second opinion before making important decisions. So we'll have a look at different approaches for determining trend bias and show how to combine them in different timeframes. Then we'll move on to have a look at how to locate potential trend sweet spot scenarios as determined by the zero lag oscillator. These are typically seen when a short-term adverse price move is overcome by trend continuation, causing the majority of traders to align themselves with the momentum. And finally, we'll look at how to improve the probability of your setups by avoiding scenarios that run straight against key support resistance. All right, so back to how emotions and psychology drive the markets. Back in the days of the free market, the accumulation phase was driven by informed buying or professional investors, and public participation would take place when technical trend followers started participating, causing prices to advance faster. At that point, business news would start to publish headlines on recent price moves, causing speculative volume and public participation to increase. And at that point, the professional investors who were the first to distribute, of course, to accumulate, of course, would start distributing, unloading their position to novice investors. But I think these days we can all question whether the narrative still applies. The news cycle has shortened considerably, and it's become much easier to participate in the markets on a professional level. Regardless, if we look at how the stock markets have developed historically, they're defined by a very strong long bias. And with the current regime, where central banks are running the show and markets seem entirely decoupled from the fundamentals, I think the argument for technical analysis is stronger than ever. Basically, there are three reasons why markets go up and down, but it's not necessary to follow business news to identify the opportunities. As we've seen, pandemics, earthquakes, terrorist attacks are quickly assimilated into the price action. There are many different schools of thought here, various methods for determining trends. I think the most important ones are first the swing trend analysis, uptrends defined when a rally is setting new highs higher than the previous high, with each low closing higher than the previous swing low, and the opposite situation, of course, when there are lower lows and lower highs, defining a downtrend. Then, of course, we have moving averages that can also help you identify direction and strength of trends, telling you whether the trend is strong, about to consolidate, or reverse. But to sum up, the purpose of technical trading is to identify trends in an early stage of their development and then follow in the same direction until it shows signs of reversing. Then we have tides, waves, and ripples of the sea. What does that have to do with trends? Well, it is a classic comparison used to illustrate how you can look at trends in different time frames. The primary trend represents the tide. The secondary or intermediate trends represent the waves that make up the tide. And the minor trends behave like ripples on the waves. And market tide, of course, can last for more than a year, often several years. Secondary trend will then be the correction into the primary trend and last a few weeks or several months. Typically, these corrections retrace between 1/3 and 2/3 of the primary move. I think 50% or half the range is pretty much the rule of thumb here. Then finally, the minor or near term will last anything from a week to a couple of weeks, representing fluctuations in the intermediate trend. So what we have here is our swing trend analysis tool. You can see here we have a bullish structure with a move that created continuous higher highs and higher lows. Let's see here, higher high, higher low, higher high, higher low, and then towards the end here setting a lower high. That alone does not mark the beginning of a new downtrend. To have a trend change, we need to break the previous swing low here, and the swing trend indicator then plots that a new trend has been detected. For short trends, it's lower lows, lower highs, lower lows, lower highs, and then we have this higher low, which needs to be confirmed by this breaking of the previous swing high, the lower high, and then again, there is a trend change indicated here by the swing trend indicator. So swing trend analysis is looking at what the market has been doing in the past and what it needs to do in the future in order for either the bulls or the bears to maintain their position. Of course, it's also worth knowing whether the market is moving back and forth in a sideways scenario, and Parry-Kaufman efficiency ratio, also known as the fractal efficiency, determines whether we're trending or range bound. This is often used as an alternative to the directional movement or the ADX indicator. Basically, the efficiency ratio compares momentum with volatility. So in a perfect trend, all bars will close in the same direction. The efficiency ratio will then show values approaching a 100 level here. A perfect sideways market without momentum in either direction will have values of 0. Obviously, the output then of this indicator will depend on the look back period. So here we have 10 bars. Then it's quite easy to imagine scenarios where you have 10 consecutive up closes, and that's where we get a very high efficiency ratio reading here. But if you use a longer look back period, here we have the same chart on a 72 bar look back. Therefore, it's more difficult to approach values of 100. Here we have a value of 24, simply because it's very difficult to have 72 consecutive up closes. But coming back to the distinction between trending and range bound, the efficiency ratio has a chop threshold, and that's when it falls below this line here. That's when the markets are moving back and forth, alternating between up and down closes, as it did in this 72 bar look back period. It will fall below the chop line here, plotting a yellowish color. A very useful feature here with the threshold is that the indicator distinguishes between long and short look back periods. So on a long look back period, this threshold will be adjusted downwards, whereas for shorter, it will move upwards. Generally, important setups will occur when both show the same bias, thus confirming one another. As we see here, the swing trend indicator showed a new uptrend starting here. T signal would occur here in a 30-minute chart, and that contradicts what we see in the lower time frame. This is the same day, but in a 3-minute chart. And Bloodhound makes it really easy to combine different time frames and trend filters, conditioning setups only to occur when they align. So in a follow-up in this presentation, I'll show you how to combine the setups or the trend states using the efficiency ratio on a primary time frame and the swing trend analysis in a higher time frame. Here's another example where there is alignment between the 30-minute chart and the lower time frame 3-minute chart on the same day. And you also see that Bloodhound excludes output here for this brief ranging market, dropping below the chop threshold here. But I think more important than just using different time frames is that you're looking at two completely different approaches for trend analysis. One is based on the price action or the market structure, so the higher highs and the higher lows and the lower highs and the lower lows. And this other one here, the classic price calculation comparing momentum with volatility. In my opinion, there's too much emphasis on one or the other, putting one price benchmark on top of another price benchmark when determining setups. It quickly becomes a challenge. On the other hand, looking at only fast versus slow moving averages, combining with another price calculation, a momentum oscillator, without looking at what the real price action is telling us, is just as problematic. Okay, I think that will do it for the trend portion of the presentation here. Coming up, we'll have a look at locating what we call the sweet spot scenarios. Again, this is assuming that you have alignment of the primary and secondary timeframes. Also, a key element to locate trend setups is that they haven't advanced too far. If a trend is obvious, you're too late, as Elon Musk is quoted to have said. So if we're looking to trade the middle chunk of a larger move, and we want to identify setups where a new trend has been challenged by an adverse move, and then if it withstands the challenge and resumes, traders are more likely to align themselves with this momentum, whereas those caught on the wrong side will close out their positions. So what we have here is the zero lag oscillator. We need to have histogram values above the zero line for long setups, and the color of the zero line is also important here because it pulls information from the efficiency ratio. So in a long scenario, we want to have a green zero line. There's also a cream color for chop, as you see here and here, and for downtrends, it's a red color. And after the histogram values cross to the upside of the zero line, we're looking for this adverse move that will be indicated by white setup bars cutting into and testing the new trend, indicating retracement setup, short-term oversold scenario. And if buyers are taking advantage of this dip, getting in at lower prices in the new uptrend, pushing a continuation move, we get the zero lag entry signal. This initial trend confirmation is defined as a key signal, key retracement signal, and the stop is then placed a few ticks below the setup bar or the signal bar, whichever has the lowest low. Again, there will be a follow-up presentation on how to set this up with Bloodhound, showing you how to call the zero lag signals as demonstrated here. Of course, you can also install and test this on your end. We do offer free trials, so just sign up for that as well, and you can experiment with setting this up on your machine. Later on, we also see a secondary retracement scenario that can be used to add to the position. The stop would then be readjusted. Again, placed a few ticks below the setup bar or the new signal bar, whichever has the lowest low. Okay, so here's a short scenario. We need to have histogram values below the zero line in order to evaluate those. Again, the color of the zero line is important because it will tell us the efficiency ratio trend reading. Just prior to the short signal here, we see this cream color again. That's the chop filter indicating a sideways market. And when activated, the chop filter is used to invalidate setups. Okay, so following the drop below the zero line, we see these yellow bars here show up, cutting into the new trend, testing it. This is the adverse move that we're looking for, a short-term overbought where sellers can take advantage of getting in at a discount in the new downtrend. And once that occurs, we'll have a key signal for the first continuation move. And the stop is then set at the setup high or the signal bar high, whichever has the highest high. And then we see no secondary retracement signal. There is just an absence of sellers, and no one is taking advantage of. There is no trend continuation after 3 setup bars. You see these gray and black bars disqualifying the setup. Also, as I mentioned earlier, we're looking for emerging trends, and the zero lag oscillator comes with the normalized histogram values. Specifically, there are thresholds here that will block setups that occur when the trend has advanced too far or when the trend is likely to have peaked, to be over the top. And this move here, strong move, blowing straight through both threshold. This is the exhaustion threshold, and this here is the late trend entry threshold. So we can see this was definitely the opportunity up here, and later on we saw no further signals, no really overbought until here, and then there's an absence of sellers. There is an opportunity here, but no really strong red trend continuation. It needs to be bright red for having a trend acceleration detection. Okay, next we'll talk about what to look out for with the support resistance levels. Of course, there are also many different methods to determine that. The most important ones are the overnight, high, low, and regular open. Yesterday's high, low, and close, and also the pivot and VWAP levels are widely used. These are key support resistance levels that the majority of traders agree and execute on. We won't have time to go over all of those today, so we'll have a look at why the overnight high and low is a good starting point. This is the swing trend on a 15-minute chart of the NASDAQ contract, the overnight high and low, and the regular open. And it's a generally good idea to know where these levels are on your charts. They're the most recent support and resistance levels, more recent, of course, than yesterday's price action, and will be the first point of reference during the regular session. Typically, once a support resistance level is tested and then subsequently broken, it often signals a directional move. So here we have a test of the overnight high just after the open, and then retracement back down to the open, and then a breakout from the overnight high. And by using extension bands of the overnight range, can identify profit targets, the 50% extension, the 100% extension, 150 and 200 are identified here. And being common profit targets, they will of course also be valid as resistance levels. We see there is some hesitation here as well as here. Also, keep in mind that the open here is used for clues on directional bias by many trading systems. Specifically used as a directional filter, permitting long trades if the market is trading above the regular open and short when trading below. Rather than using the open specifically, I prefer using the first minute of trading. It's less arbitrary than simply going with the first tick of the session. A lot happens during the first minute of trading, and using that range will give you a more stable trend bias for the session. This is a 10-minute chart of the NASDAQ. First minute of trading is plotting near the overnight high, then a test of the overnight low before we see the market retaking the open here. But if we took this first setup here, we'd surely get in earlier with 2020 hindsight of a nice move. But it's heading into this overnight high level, and that is, as I said, the first point of reference. We see there is resistance here, so there's quite a bit of risk associated with that, especially if you're looking at where the stop level will be located. So a 1-to-1 risk-reward ratio here at best. And so this here is a safer trade where we've broken through this resistance level, coming back, testing support. So there will be tailwind scenario there. So once these key support resistance levels break, they're attractive because traders who got trapped short at this level will be anchored and try to get out at break even, and we can expect demand from this position to help form support. You can think of the overnight high and low and the regular open, yesterday's high, low, and close, the pivot and VWAP levels as anchor points. These are the same levels for everyone, and traders will execute on them because there is no doubt as to why you're doing what you're doing. No really room for subjective opinion here. It's factual, And we're looking for a critical mass of traders that are likely to respond in a coordinated way to the same price levels at the same time. And coming back to what technical analysis is all about, namely herd mentality, I think most of you will agree it makes sense to be aware of objective price benchmarks and to get a second opinion on trend bias, specifically in our case, before pulling the trigger. So if it's all right with everyone, I'll now transition into the promotion we've prepared for Shark Week. That way we can keep the presentation short and to the point and have more time for questions towards the end. We've got the swing trend, the opening range, and the zero lag oscillator with the library in our event bundle here today. With that, you'll also get the step-by-step tutorials on how to use our tools with Bloodhound and Blackbird. We'll also throw in a complimentary consulting session helping you get everything set up on your end. So list price for all of this is $835, and at $695 you get a very good discount here today. We also have a special in the membership section. Lizard Indicators members already get a 10 to 20% discount on our tools in the premium section, and we've created a special bundle rate for you guys, extending the additional discount for this event. So this is where you go to register for the promotion, lizardindicators.com/Shark Week. If you've been sitting on the fence regarding Bloodhound and Blackbird, this is a really good opportunity to dive into it. Not only do you get the amazing capability of the Shark Indicators tools, you also get our premium suite tools here, certainly the most extensive indicator library available for NinjaTrader 8 as well in the bundle. And as I mentioned, there's also a special offer for existing library members. So just go ahead and log in and you'll find it alongside the premium suite indicators. All right, that's a wrap. If you have any questions, reach out to me via the contact form over at lizardindicators.com, otherwise at info@lizardindicators.com. And with that, I would like to thank everyone for checking in. Hope it's been of value, and I look forward to seeing you in the member section soon. Chris Lassen at lizardindicators.com, signing off in Berlin. Bye-bye.